This voice is taken from an article with the title, How Does the Economic Calendar Reflect Changes in Market Expectations for Inflation?, which has been published on TraderTalks.net. The Economic Calendar is a useful tool for investors and traders to track upcoming economic events and to measure how these events may affect market expectations of inflation. An economic calendar can provide insight into the potential short-term and long-term effects of an economic event on the market. Inflation is a measure of the increase in the average price of goods and services in the economy. It is usually measured by the Consumer Price Index, CPI, or the Producer Price Index, PPI. When inflation rises, it means that consumers have to pay more for goods and services. The impact of inflation on the economy can affect exchange rates, interest rates, and other economic variables. The economic calendar can be used to track changes in market expectations for inflation. It can show the upcoming economy. See events that may cause changes in inflation expectations. For example, if the economic calendar shows that the Federal Reserve is scheduled to raise interest rates, this could lead to changes in market expectations for inflation. The economic calendar can also be used to track changes in the news. Events like major economic data releases, GDP, CPI, unemployment rate, etc., central bank meetings, and political events can all affect the market's expectations of inflation. By tracking these events in the economic calendar, investors and traders can gain a better understanding of how the market is likely to react to these events. The economic calendar can also be used to track changes in market sentiment. Market sentiment is the collective opinion of the market, and it is often affected by news and economic events. By tracking the market sentiment in the economic calendar, investors and traders can gain an understanding of how the market may react to upcoming events. This can be useful for making trading decisions and determining when to enter or exit a position. Finally, the economic calendar can be used to track changes in the level of activity in the market. By tracking the level of activity in the economic calendar, investors and traders can gain an understanding of how much trading is taking place in the forex market. This can be useful for gauging market volatility and determining when to enter or exit a position. In conclusion, the economic calendar is a useful tool for investors and traders to track changes in market expectations for inflation. It can be used to track upcoming economic events, news, market sentiment, and the level of activity in the market. By tracking these changes in the economic calendar, investors and traders can gain a better understanding of the potential effects of an economic event on the market and can make more informed trading decisions.